Hi, I'm Dorian Lam, and welcome to Start with the Close in Mind. As an owner of a title company and a seasoned real estate professional, I've seen firsthand how focusing on the close is the key to getting the results you want. What I've learned over the years is that this principle doesn't just apply to real estate, it applies to business, strategy, and life. Each episode, I'll share the tools, insights, and real-world experiences, both the wins and the lessons learned, that have helped me and others achieve our goals. I will also bring on some of the most successful business minds across industries to uncover how they approach deals, decisions, and success by starting with the close in mind. Welcome to Start with the Close in Mind. Let's dive in. Hello, everyone. Welcome back to Start with the Close in Mind. Today, we're sitting down with someone who truly embodies the philosophy of Start with the Close in Mind. It's my dear friend, Tej Brahmbhatt, founder and managing partner of Watchtower Capital. Tej is an investor and advisor who has built a reputation for seeing the full picture up front. In fact, one of his beliefs is that battles are won or lost before they're even started. But we're going to learn today is how that mindset translates into deal making, leadership, and decision making. We'll dig into how preparation, clarity, and value shape success long before the close, and how understanding people, culture, and risk early on can completely change the outcome of the deal. Before we get to that, though, please meet Tej. Tej, why don't you tell everyone your story of how you started Watchtower Capital and why?
Thanks for having me, man. I love your podcast. I love that you want to share with everyone. So I'm a big mentor. So for me, this is like geeking out on how to help people, right? So why we started Watchtower was basically, I'm a corporate banker for 17 years. Over the last 5 years, of my last 5 years of banking, my network grew, got bigger, deeper, broader, and I was serving people less. That was like the inception point to be like, I got to do something else. Sat with my advisor, which my mentor is Scott Rosenblum, who's our attorney. So I basically sat with him from Bank of America forward. Then I went to Sterling. Then my last stop was City National. And at that point, I realized, you know what? I need to go do something independently. As most people said, I'm too gregarious to be contained, good and bad. And I thought at that point, let me go serve our clients better. And that's the nexus of how Watchtower Capital started. It was a crazy ride. A little depressing in the beginning, didn't know what to do. We figured it out, and here we are 7 years later, having helped hundreds of millions of dollars in fundings and a small team that really gets involved, helps companies grow, scale, and exit. And that's kind of the genesis of how we started.
I didn't realize it was already 7 years. Congrats on that.
2008. I know, someone asked me, and they're like, you've been around for a few years, right? I'm like, yeah. I looked at my LinkedIn. I had to look at my own LinkedIn. I'm like, oh, wait, 2018. So, yeah. Pretty cool.
I like this question generally when I hear and talk to founders of companies. What went into the name of the company and why is it Watchtower?
Good question. I'm glad I didn't prepare for that even. So I started with the Greek gods. Everyone wants to be a Greek god, right? From A through Z, Apollo through Zeus, every Greek god name, Athens capital, Apollo, Zeus, all taken. So I was like, all right, let me step back, not be like everyone else. And I spent weeks with like 3 or 4 people. What can we do? And they're like, Scott was like my advisor and attorney. Think about who you want to serve, why. I was like, all right. And at the time, it was like Game of Thrones was relevant. And I was thinking about it. And I said, well, I'm like the guy who goes out and comes up with ideas for clients, right? I'm the guy who's protective. And, to my detriment, I'm like uber loyal, uber cutthroat when it comes to protecting my people. So I was like, all right, something old school, but new, right? I'm like bougie, but I'm old school, which is very weird. So I came up with like a tower, like I'm a sniper on the tower, protecting people. I can see things from miles and miles away. And I thought, let's use like an actual tower. So if you look at Watchtower Capital's insignia, it's the carve-outs in the tower where people used to sit, and not with guns, but with arrows or whatever. And so that was the start of it. And then I hired a designer to be like, that's the thought. Let's incorporate the W or the C or something. So make it look Wall Street, iBanking, fresh and new, ultra modern, but it's got to be a tower at the end of it, and Watchtower Capital. So there's a U that holds the tower with the cutouts that looks like an old school tower, and then Watchtower Capital in there. So that's kind of where we came up with it, which is I'm watching over my people, my clients, my COIs, my friends, and I'm bringing you things, and I'm the guy who's going to why you're going to hire me, not because I'm the smartest or not because I have the best products, but because you trust me to do what's right for you, which is where Watchtower came from. That was a long-winded answer, but yeah, that was a cool question, and I'm very proud.
No, look, I think the name makes a lot of sense. Even I felt that way before I even asked the question. I think it's a great transition though, because the word watch, meaning watching over, is in the word itself. And then being in a tower, I mean, it leans right into what one of your philosophies is, or one of the things that sits at the core of your philosophy, which is being able to see the full picture. So you mentioned the background in banking, and then we've spoken about your name. Could you tell us a little about how your background has actually shaped the way that you feel about how a real or how an investment banker should help, and how that shaped the philosophy and approach that you at Watchtower Capital provide?
I mean, it's really comes from a place of how I kind of grew up, how no one helped me in the beginning. I had to figure it out myself. And I thought the best way to serve value, right, is almost selflessly, but you gotta, I'm not a not-for-profit, right? I gotta make money. So it's kind of like thinking about end result, right? All in the back end. What is that ICP, ideal client profile? What do they want? What is their outcome? We always can't, almost rarely do we get everything a client wants and needs done? But if you get most of it done in a manner that they like and choose, then they're always happy, right? Like you realize when you're set out to do something, right? Whether it's, I want to buy this thing, I want to do this thing, I want to read this book, I want to learn something. It's never perfect. So it's never about the destination. It is, because if someone wants to sell their company for 80 million, give or take, it might be 75, it might be 85. It's not perfect. It's close enough. But the journey of it, I felt pretty comfortable. It was a rough ride, but Tej and his team walked me through it. So that's the thought of why we do it that way. So that's where it really comes from, is thinking about the client from their perspective, their pains, their agonies, and how can I alleviate that, show them a better way. And it's self-serving, right? Because then I'm the true chief advisor, the chief external advisor to them. That's how I think about things. So I'm willing to starve so I can feast later. So I don't look at a transaction. I don't look at, well, I can only get you this. Let me feed myself by doing that. No, I don't think I can help you right now, but here's 3 things you should do. So that's the thought process, is serve them the way, like if I don't have kids, but if I had a son and he's like, I'm stuck here, what should I do? I would give him the best advice I possibly can, whether I can help him, someone else can help him. That's kind of how I think of clients. And I truly think that way, right? It sounds a little cheesy. Oh, you're thinking about the client only. Yeah, it's true. Because if I think about them, 80% of them don't hire us right away. We're not a volume shop. 20% of them hire us, but the 80% eventually come back. So my long-term pipeline, I have things in the pipeline for 5 years from now because of the help we give today. Feast later, starve now. That's the thought.
Yeah, value add approach, right? You got to think long term in general, and also long term. We always like to say that we do business with people that are like minded. That term
100%.
is used, I feel, unfortunately, very loosely. And what I do find as a common thread when you think in that way is that when you think long term, when you think about adding value, that it's part of the same kind of thought and process of those. You're in line with a lot of people who think that way, right? And they're more able to recognize the value in that, right? Because they're thinking long term and they're not thinking about just right now.
Right. And
So
then you attract the right clients because of it. You think the long-term thinkers, which aren't the penny wise, pound foolish, and then there's a whole algorithm that figures itself out because of that, the ethos and the culture of finding the ideal client for you, for us. So we're serving them, and then we're a good fit. So then they come back to us over and over. It's hard. It's exceptionally hard. But
yeah.
right.
Yeah. So we're talking about your approach. We're talking about kind of the realm and ecosystem that you work in. We're talking about the kind of, I wouldn't say ideal. Well, yeah, ideal. You said ICP, right? So the ideal operator, and you mentioned kind of lending advice. What do you see are kind of the 3 most, or the most, kind of common pieces of advice that you are giving? Like what is it that you find in companies that is generally kind of overlooked and that you see as a piece of advice that you're giving up front?
Okay. Good question. So let me preface that. And if I get too long, let me know. But let me preface that with what we do is we advise companies as consultants, right? And that could be strategy, sales, scaling, operational efficiencies, improvement, financial cleanup, et cetera. So we do all of that more than just an investment banker. Because when you work for like a Goldman, Bank of America, you're simply running the process, right? You want to buy a company, you want to raise capital and or sell your company. That's it. But for us, because we're independent, we're helping to scale a company, right? Sales, go to market. So that's kind of what we do. We advise on how to take your company from this level to the next level, whatever that might look like. And it might not be me directly. I might bring in an accountant. I might bring in a sales specialist. I might bring in someone to come in and like an interim CFO, because what you don't know is the deadliest. And because we talked to so many companies over the last 20 years, I can say, you might not know this. So that's the foundation. So the one thing, lowest common denominator theme for most companies, which is our target client, if you've never run a process, if you've never bought a company or sold a company, most companies aren't prepared to do the roadshow, no matter how much they think they are, for two reasons. One, the process itself is arduous. Unless you've done it, you wouldn't know that, if you're selling your company, your financials need to be not just clean and clear with footnotes, but a third party has to either audit them or review them or whatever it might be, or get a quality of earnings. So if you've never done that, if you've never gone to a major bank and said, I need $50 million, if you've never had an external party fund you, or you're looking to sell your company, they wouldn't know to do that, right? Because they're a good company. Like, yes, we have great financials. We do this. We're self-funded. They wouldn't know to prepare for someone external to come in and look at them. That's a different level. Only big companies know that. So that's the first and foremost thing. Second to that, when you're running the process, you're wearing multiple hats, right? You're wearing the hat of, hey, Mr. CEO, CFO, I need you 3 hours a week to get on investor calls with me to pitch investors. That's one job. By the way, you also have a full-time job, keeping the cash flow company running and everything else. And then they realize in the process, they're like, okay, I forgot that I can't just stop this to do this process. So that you got to wear multiple hats. That's something they don't know. And the last thing, I always say the word penny wise, pound foolish, because most of us, every one of us, well, I'll fix that if and when I need to. I'll cross that bridge if and when I need to. I will upgrade that when I need to, because why would I spend 80 grand now if it's not coming back to me as ROI, right? But that's silly, because if you think I'm probably going to sell my company in 2 years, and you wait until the last 3 months to upgrade your financials, now you're paying more because the accounting firm is going to charge you double to get a rush job. You're stressed, timing, the market, everything else. So the more you prepare earlier in advance, which is why I like that quote from Sun Tzu, which is most battles are won or lost before they're ever fought, the better prepared you are. And even like, you and I love sports. Most athletes, they live in the practice, right? They don't go into the finals or NBA or championships or Super Bowl. They put so much in, they already kind of have an idea of how it's going to go. That's the thinking where most people who've never run a process go wrong. And that's my job, is to put them through that pain as tactfully as possible, almost walk them out of the sale. The things I say, it's laughable. Most of the things I say to a client who wants to hire me, they always go, do you not want my business? It's how our conversations go, because I give them the ugly first, then we work on the bad, then the good, I allow it to come itself. That's the thought process.
Yeah. It's like any good coach. And one of the things that you alluded or, gave an anecdote about is just the approach that many companies take, which is one that is reactive and not proactive, right?
100%.
And when you get into a scenario where you're just constantly reacting to things, you're generally already behind, right?
Exactly
that's
right.
the kind of thought process. So you discuss kind of financial modeling, not modeling. You mentioned having a hold on your financials and knowing what they are and having them presentable. We'll use that word.
Mm-hmm.
What's your thoughts and beliefs around the other aspects of companies? The things like people, the values, the culture. Does that factor in at all?
It always does, but the gravity of the situation depends on what you want to do, right? So, for example, if you're simply raising capital and you're growing, culture matters, your financials matter, the story matters, because banks are going to basically look at your financial story on paper and then look at some forecast repayment models, and do they believe in your industry, where you're going, where we are in the market cycle, and say, if we extend 40 million right now, here's what they're going to use it for, acquisition or whatever. Do we believe that's going to work out, et cetera? So that you have that part of it. Now imagine you're like, well, I want to sell my company, or I want to buy a company. Now culture and what I call quantitative is always obviously important, right? Most deals die. Most everything happens in the qualitative, because quantitative, outside of fraudulent financials, qualitative is what it is, right? Our company generates whatever, right? 18 million top line, 7 million EBITDA, whatever it is. That is a finite number that you get to eventually. Qualitative, though, is if we're selling our company, well, if the CEO and the team, say 6 executives or partners, want to stay on, I got to be very cognizant of who I bring in. If it's a private equity, simply wants to do a roll up, fire everybody and scale them, that's not a good fit. So cultural fit is mission critical more than financials, because I can bring in a fund or actually a strategic. Last exit we did, we brought in a strategic. The CEO and his team were staying on. So more than the financials, they were willing to overlook financials because they knew the team, the personal assets of that, the mind of the CEO and the team was more important than what they've done, because they can bring them in, take their IP and build them faster, because this was a $400 million company. The other one was a much smaller company. That's the thought process of, depending on what you're doing, the financial part of it is important always, but that's like a foundation. Most deals die for qualitative, which is cultural fit, get timing, other things that you can only control so much. So know when you're going to market, know what you're doing, I always say know your audience, right? When you're selling, when you're doing anything, you're dating, know your audience. You're selling, know your audience. You're pitching, know your investors, know your audience of who the founders are. Once you know your audience, if I'm selling a company, that's everything. And that's my job, to advise clients. Everything, how you speak, what you say, how you present, what the financials look, everything. So knowing your audience ultimately is such a critical thing. And depending on the transaction, culture and everything else plays more of a weighted role versus I'm just borrowing 20 million versus, well, I want to buy a company and that team wants to come aboard, but they don't like your culture. Money doesn't matter. There's companies that will never come aboard if they don't like your culture, if they're going to stay on. So there's a lot of that too.
Yeah. So it's not just the financials.
Actually not.
You just mentioned that intellectual property has to do with it, proprietary process has to do with it, the people have to do with it. It all factors in, right? With regards to especially
what you're doing, each of those is a weighted factor, and you don't know that. So you got to then think about it a year in advance and fortify whatever silos you need to fortify for the transaction you're doing. And most people, they don't want to put in that much work. So that's my job, is to say, it's expensive. You're going to pay us 5-figure retainers monthly, but we are going to take your company and present it like a military level, buttoned up, billion-dollar company, even though you're only $100 million company. That's the thought.
Yeah. So, we're talking about how to increase saleability or, make it more efficient. When and what is your advice to when companies should be doing all the things that you do? So at one point, say, just for example, I'm saying I'm going to sell my company. At what point do you think they should be, how far out in the future, or however you look at it in the past, do you look at, I need to be and start doing this now? So in other words, if I said today in the same example, I'm going to sell my company, at what point do you think we'll be able to do that? What's generally your guidance there?
If you, all things being equal and you can really control the timing, I would say 2 years is ample time to defend or boost your valuation, clean up all of the above that we discussed in the last 15 minutes, right? Bring in external people to do what you need. So, we have an example right now. It's like a $70 million company, but they use tax returns. And they got to this point on tax returns, which is okay. But if we're going to sell the company for $150 million, the buyer is going to be like, tax returns, are you crazy? And what happens is, and just a quick 501 level diluted down to 30 seconds for those of you who are in an M&A world, you're selling your company and you're going to the buyer, strategic or private equity. If they're the ones who say, well, we're going to do a Q of E, quality of earnings on you, we're going to need upgraded financials, and they're the one doing the work, every time they do something in their favor and not yours, we call you go down by half a turn or a turn, which is a multiple, a turn in EBITDA or top line. If you're a technology company, and in the AI world, multiples are still between 12 and 18 times. Every time a buyer senses you have 3 things wrong, they're like, well, we're not paying you premium. We started with 15x. After these 3 things, we're already down to 12 or 11x. So by me doing these things with the client early on, upgrading financials, upgrading your contracts, making sure all your verbal contracts are memorialized on actual reliable written contracts, all these things, right? IP, your IP is protected. There's filings, etc. All those things, the earlier you do them, all you're doing is ultimately defending your valuation, getting a better bang for your buck. And yes, if you think about this, here's the rebuttal. Well, all this is going to cost $300,000-$400,000 over the next year. Let's do the math. You're a $10 million EBITDA company. We're going to sell you for somewhere between, if this was, let's say it's not AI, it's manufacturing or furniture. They trade at 6 to 8 times. 6 to 8 times EBITDA, 60 to 80 million bucks, whatever it is. And if that's the case, $68 million valuation, and someone comes back and gives you a 5X versus 7X. Do the math. You spent $400,000 to get a check for 68 million versus 60 million, whatever it is. I'm a numbers person. Everything, I got to be able to 10, 15, 20X it for our client. So that's the thought process, is that 2 years in advance gives you ample time. And I can go on for days about the 30 or 40 points, self-serving points it does. Less stress for you. You time the market better. Because if you said right now, Dorian, you want to sell your company over the next few years, I can prepare you. I can start preparing you now. By next June, you are ready to go for the process. If the market's up here, there's a lot of activity. Private equity firms are writing checks. Things are moving forward. Great time. If that's not the case and you're not rushed to sell it, let's just be prepared and then pounce when and if the market is in our favor. Or while the market's bad, I can go privately to buyers and have a conversation principal to principal. We don't do auction for so many reasons, principal to principal, and say, okay, we have a company. The market's bad right now, but it's a really strong company. They're just poised for an exit. I'm going to give you first crack if you want to look at it. Then you can do that. You can play that game, which is not a game, but you can play strategic angle of, we want to sell. We don't need to sell. We can take 2 years. So we're protecting. So that's the thought process of, the earlier you prepare, the less it costs, the better you protect your valuation on the back end. And you talk about with the close in mind. Close in mind is mitigate all your risk, get a bigger check, less stress, less money spent, and you enjoy the journey, by the way, of the destination, which we even talk about. The journey, it's less stressful. You don't have to slow down your company, and you get to the end result in a better, fun, and friendly way, right?
Yeah. Yeah. Look, you want to turn the multiple up. You don't want to turn it down, right?
Exactly.
So, you use the term strategic as one of the modes that somebody sells. What are some of the others what are some of the other reasons that others do sell, right? So you've given examples of kind of private equity coming in, and in some cases actually define what strategic means, and then give us what some of the other reasons are that people generally sell.
From the clients, from like the company's
or
perspective,
in general, just general advice. It could
reasons
be
why you might want to sell.
Yeah.
Well, first and foremost, right now, everybody's heard about all the baby boomers that have these companies that have matured, and they've matured, and they have kids or they don't have kids, and they can't succession plan, right? So usually what happens is there's companies that are mature. The CEOs and founders are aging out, right? They're into their 60s, 70s, in some cases 80s. They need to sell because their kids don't want to take over the business. They don't have strong employees that have equity in the company or they believe in, or they're just like, I'm wealthy enough. I don't care what happens. I want to sell. I don't have family just to give it to. So that's the first and foremost. Think about why. It's timing, meaning it's my time to sell. I'm 75 years old. I'm worth 50 million or 60, whatever it is. I've done this for a long time. I enjoyed it. Now I'm not. That's the primary driver. The other one could be a bunch of things, right? Certain industries got hammered, whether it be because of tariffs. Since COVID, things have changed. A lot of e-commerce companies flourished because of COVID, whereas a lot of brick and mortar companies were just hammered as a result, right? Entertainment, hospitality, food, beverage, retailers they suffered. Some of them were forced to sell. Great for our buyers, not great for the sellers, right? So that's the thought process is either you're proactively, and this goes back to our always be prepared, either you're proactively selling for a reason that you're controlling, or you're reacting to an external environment, which is the market's bad. My line of credit is maxed out. I can't withstand these tariffs because I buy from China or wherever so much that now it's costing me too much. And the smaller the company, the more it's affecting them. And if they can't adapt and pivot, well, they're going to have to sell or merge. And let's be honest, in our world, we say merger, but it's always a buyout. You say merger because the seller finds it more friendly. As the buyer, and we know it's not a merger, it's a buyout. Whose name is going to be on the front door? Who's buying? That's the culture. That's who's going to control it. And that's what it comes down to. So that's the thought process.
Yeah. I mean, look, that makes sense, right? Especially the story of somebody who put their life's work and passion into building something. And it's just, it's time because of, either they don't really have a succession plan that makes, sense to keep it within their own sphere, or it's just time, right? It's just time to kind of cash out and retire. What are, I feel like this is a conversation all the time, right? Which is help us understand the general parameters or mechanics by which, now pretend again, I'm selling my company, that I should view what I'm getting. And let me clarify that more, meaning you gave an example of a 10 million EBITDA company. There's a multiple of 6 to 8, which is say 6. It's a $60 million sale. What is typically the structure? Because I feel many times people think of it as a $60 million check at closing. More times than not, that's not the case. There's there's a bunch of terminology that I'm not even going to say because I don't want to get it wrong. But give kind of the brief 101 of just how people should view what they're about to get.
Good question. I didn't think you were going to ask that. So I'm not going to name the company, but there was a company and someone's like, oh, look, this person created is it ad tech or AI? Look, they sold for $1.8 billion. And I laughed. And I'm like, what does that mean to you? And not an investment banker. Dude, guy's sitting on $1.8 billion. Okay. And we laughed. I said, let's have a drink. We were having a conversation. And I knew this. I knew the person who knew the person. But ultimately, the person was sitting on like something to the effect of like 111 million. That's great.
So less than 10%, right?
But think about that. 2 reasons. It's that number that's sold for. That's the ultimate purchase consideration or the actual value of what the company's paying. But that's not like, oh, here you go. Wire hits the next day, right? 2 components. The first component I'll cover is the breakdown of the structure of how you get paid. It's cash at the table. When I say cash, the wire of what you're getting paid up front, right? Then there's an earnout component, right? That protects the buyer. Earnout meaning over time, if the seller hits these triggers, sometimes they're performance-based, profit-based, top-line-based, and there's a whole other gamble of a negotiation that goes into it, days of it. That's the earnout. And then you have roll of your stock into the new company, because if you're selling your company to us and you're going to stay on, you better believe in us. So we're going to tie your money into our money for the long term, right? So right now, if you were to say, what's the average percentages? Somewhere between 50 to 65, 70% upfront. So let's just take a round number for our space, right? The realistic space, I call it. Sell a company for 100 million. Sounds amazing. Especially most of our CEOs are like, some of them are so young, they're barely in their 30s. And we're getting them a check, total sale for 100 million. That means likely somewhere between 50 and 70 million at the table. That's pre-taxes, et cetera. There's a whole other conversation there. But that's part of prepping early on. You set up succession planning, slats, other things, gifting to your kids if you have kids. So you protect that. So instead of having a 50% tax burden at the table, you end up with like a 10, 15% burden. And on $50 million, that's a huge difference, right? So that's, I don't want to go into, but that's the first one. Then you have the earnout, which is over time. And there's a whole bunch of things that go in there, but 1 year to 3 years. And that could be performance-based with a salary, without a salary, top line, just EBITDA based, profit margin, whatever. Then you get that roll into the stock. So that's kind of how it works on a $100 million check. 50 at the table, 25%, 30% earnout, 15 to 20% roll. And that's the breakdown. So that's the one silo. The other component is that's assuming you're 100% equity of the company.
Exactly.
The more you've borrowed from external institutions, angel, friends and family. Oh, I gave my family 5%. Oh, I gave my employees 10%. Oh, I did this. So in this case, $100 million company, the founder was 80, I think it was like 80%, which was nice. And his chief sales officer was 5%, family, friends, et cetera, right? So 80%. So 50 million at the table, 80% of that, right? That's what his cut is.
Yeah.
And that's how it works. But with most companies, if you've gotten to a round A, which is, angel investors, friends and family, angel, then you get to the real, I call it institutional money. Most of those people, like that example I gave you for 1.8 billion, but they had borrowed so much, not borrowed, they had gotten so much equity that by the time he sold the company, yes, it's a great valuation. And in the paper, I'm founder of a $1.8 billion company, but it was owned 50% by one main lead investor. At the time he was done after 3 rounds, friends, family, everybody. And by the time the cap table got diluted down, he was somewhere between 10 and 15% owner. And then he sold and he ended up with 111 versus this person who sold it for roughly 100 million, still pocketed, right? If you think about that, 80% of 50 million in a short time frame. So that's the long and short of how that works.
That's very interesting. And I understand also that's in general, right? All of it is negotiated and kind of discussed.
Oh, these are days and hours of negotiations for each of those things I talked about.
Yeah, likely the potential of a whole separate episode. But I think for the audience, I think the key takeaway is that There's generally the cash component, there's generally the earn-out component and the role. And then you have the component of whether or not, you've either brought in investors or you have debt, right, on
Yep.
the actual
The
company
cap
itself.
table. Yep.
So it's something that many often forget. They just think of it as it's $100 million company. I'm walking away with $100 million.
Yeah. You see in the paper, oh man, this guy's got a check for 500. No, he's got a check for 80. But
Yeah.
I'm not diminishing 80 million, but sold for 500 million. Yeah.
Yeah. Like I said, that could be potentially a whole separate, different episode. And that's an interesting question because that there is a kind of a misunderstanding behind that, right? And I always ask, my guests this question, which is, what is something most people misunderstand about what you do, right? About you as an advisor. What is it that you find is, and this is a good way to preface the question, but it's what are the scenarios that are not good for you, right? Because people misunderstand what you actually do.
Yeah. Well, it's funny, right? I'll go the simplest person, the average person who's not on Wall Street, not in sales, not a CEO of a company, whatever, right? The average, let's say someone in marketing who does whatever, right? Or back office. Oh, what do you do? Investment banker. Yeah. So did you hear about NVIDIA stock? Did you buy that? No, that's a wealth advisor or that's a financial advisor. Oh, well, what do you do? And then I've learned to basically say, you know how when you need an advisor, like you said, I want to buy stock or manage my mutual funds or whatever, that's a personal advisor to you.
Yeah.
Companies also need advisors. The easiest way to put it is I'm the advisor to the company, right? Yes, the company is a machine. It's not a human, but the people that run that company need me so they can ask, here's what we're stuck on. Here's where we want to go. Here's what we want to do. We need connections. We need a certain level of acumen. We need whatever it is. So that's the first and foremost is most people don't know what investment banking is, don't really know it. So I always say advisor. M&A advisor is probably a better term. And you use the word investment banking because of the fact that if you're raising capital or, if you're doing underwriting and you have to know certain things financially, that's a better term. But ultimately, the working utilization of that word is M&A advisor, basically meaning, do you want to buy a company? Do you want to sell your company? Do you want to grow your company? And do you need money with any one of those points to get to that level? That's kind of what we see a lot. That's from that perspective. That's usually what we hear is, so do you guys lend? No. You tell us what you want. We package you and then we go out and get the money for you. So you won't write me a check for 40 million. No, we won't. Right. I mean, we can co-invest, but we won't.
Yeah. That's interesting. The delineation between, I'm not buying stocks for you, right? I'm helping you either buy or sell a company,
Correct.
Which is a big differentiation. So I could see how that's one of the misunderstandings that you always kind of have to deal with. So I'm going to wrap up here, right? So, to summarize what we learned, winning deals really starts long before the closing table, right? So if you're thinking about selling, some general rules, at least 2 years, you should be talking to somebody like Tej to help get yourself ready to be sold, right? Because success is in the preparation, the clarity of what you're actually selling, which in this case is your company. So I want to thank you, Tej. And I want to remind listeners that battles are won or lost before they're even started, right? And that, I think, probably matches the spirit of Start with the Close in Mind more than anybody else. So I felt like this conversation was very relevant to what I'm helping the audience understand. So again, thank you, Tej. Help the listeners figure out how to find you. Where are you out there if they wanted to talk to you?
Yeah, no, I appreciate it. This was awesome. And I feel like we can do 5 parts of this, but LinkedIn, that's my first and last forum, which I really love sharing my education about this stuff. And where most clients find me. So if you put in my first name, Tej, space B, you'll see in New York especially, I'm the first one that comes up. So Tej, and then my last name, Brahmbhatt. But as soon as you put in the B, you'll see a blue diamond. I've done that strategically. There's a blue diamond that pops up under my name. That's me. So Tej, B, and you start typing and you'll see my name pop up on LinkedIn. Otherwise, I do have a website. It's a namesake, tejbrahmbhatt.com. It's easy. I post things like, here's what I learned in a deal. Here's if you're selling to this corporate. Here's what you want to think about. Anything with sales, growing your company, scaling your company. I share it as a mentor, as an advisor, whatever. And tertiary, I do use Instagram to share some of my knowledge and post some things and events or whatever, which is Tej Takeaways. That came about because a client of mine said, hey, every time we're sitting with you, and actually a banker of mine as well, that said, hey, every time we sit with you, we take away something. you should start like a Tej Takeaways. And I was like, okay, great. So Tej Takeaways on Instagram. And that's how I share it. So yeah.
That's right. And, I encourage the audience to check that out too. I have taken my own takeaways or been the recipient of watching your takeaways. So there's a lot of valuable insight in that. So again, for the audience, use somebody like Tej to turn up the multiple and not turn it down. So start with the close in mind. Thank you again, Tej.
Yeah, man. Awesome. Thank you.